tell me about this journey now with how many thousands, tens of thousands of people that you've talked to, what you've learned from them. What can you share, whether it be a story or example of how? Let's start with how to raise funds for a business and why they should raise funds, why they shouldn't. Maybe you could talk about some of those elements. That would be kind of a fun start.
Mm-hmm.
Yeah. So
maybe why they shouldn't. Yeah, why people shouldn't raise a fund to do
so raise a fund or raise funding?
I'm sorry, funding to get
Okay.
investment. Why they shouldn't seek funding.
So, yeah, in my opinion, so today 97% of businesses don't raise venture capital money, right? And my estimation is there's probably another percent in there that shouldn't, because they don't have. I mean, there's a lot of factors. So if you decide you want to raise venture capital, you have to recognize that venture is kind of a drug. Once you're on it, you kind of have to stay on it. Otherwise, there are really, really bad side effects and outcomes. And even if you're on it, there are some things that you may not particularly like. And the reason ultimately it all boils down to time. So if you value time over control, then raise venture capital. But if you value control, if you value balance, if you value a lot of those other things, then like venture capital is probably not the right route for you. And then there's a bunch of other factors that determine whether or not the company you're working on and the idea you have is one that merits venture capital money. Because if you don't have good alignment there, raising money will be a slog. And to the extent it's not a slog and you end up raising capital and you're successful, it's gonna be problematic. Like you're not gonna have a great life. So, and you ultimately won't be successful. So what are those things? Those things are, it needs to be a big market, right? If it's not like a really big market, then it's really hard to justify taking venture investment. And you have to have like a credible story of how not only is it a big market, but you're going to take an outsized portion of that market and display some like true monopolistic, power within that market. Because what we're investing in, if you think about the typical fund is probably about 300 million. Of course, now it's kind of scaled up to like 500 million. The typical Series A fund at $500 million, when they write a check into your company, they need to feel confident that you can return their entire fund off of just your deal, which means if they own 10% of the company by the time it goes public, after dilution and all the things that happen, because it just takes so long and so much capital to get there, they have to return $500 million off that one deal, which means you have to be worth $5 billion. And the to get to a $500 billion valuation, that means that you probably need to be doing about at least 500 million in revenue, right? And so if you're operating in a market that's only $1 billion in size, you're half the market, right? So you really need to have like these big markets. And even if you're in like a $5 billion market, having $500 million of revenue means that you're still sitting on 10% market share, which is a lot of market share, right? And so you just have to be clear that like that's what you're kind of signing up for. You're going to have to raise a lot of money. You're going to have to give up a lot of equity. You're going to have to give up a lot of control. The advantage, though, is that you get to move really fast. Other companies that don't raise the capital take decades to build what VC-backed companies can build in, half or a quarter of that time. And so like that's the thing that you get to grow a much bigger pie. You just get a smaller piece of it, but you get to do it in less time. I remember we had like one of my favorite entrepreneurs is this gentleman, Josh Coates. He was the founder of Instructure. Before that, he was the founder of a data backup storage company that he raised only a little bit of money. I think he only raised like $2, maybe $3 million, and then sold it for somewhere around $70 million And so he owned like the vast majority. And I remember him getting into a big argument on a panel at one of our conferences with this other guy who was a founder of a company called Fusion.io. And Fusion.io was another like super successful company, raised tons of money, I think like north of $100 million, but grew to be worth a lot more. I think they ended up being worth $1 billion. I'd have to go back and look. Anyways, they had this argument on stage, right? And Josh was like, don't raise money or don't raise much, own more. And the other guy was like, no, grow something bigger, right? But in both cases, the one area where they agreed was the beauty of raising money is you get to move fast. And so it's just something that like I tell a lot of founders to think about, because like once you raise, you have now like set those expectations for the company that you need to build this into something big. And your next investors, like they care about what happens when you get big, and they care about like you meeting the milestones to raise more money and more money and more money and more money, because that's required in today's day and age to hit those kinds of valuations and outcomes. So that's a long way of saying I think the first step is like sit back and think, is this something that like, one, I want to sign up for, and two, do I have the platform to really take it there? I just chatted with a founder recently, and he has an amazing business that he's bootstrapped to several million in revenue, profitable. And he was very intentional. He was like, I don't know. He's like, up until now, I didn't have a pathway to build something big. And so I didn't pursue venture investment. He tapped into a huge new market with his product. And so then he was like, you know what, I think this actually does make sense at this point, and I'm willing to sign up for it. Right. But I think it's important to go into it with both eyes, wide open in what you're doing. And once you have that clarity, then it also becomes so much easier to tell your story to investors, right? Because you know the things that they're looking for. They're looking for big markets and the ability to capture a big chunk of that market. And you can start framing and your pitch around, why you're the right person to do it, why your company and your solution is the right solution, et cetera, et cetera, et cetera.
Fantastic. I've got lots of questions. And one of the comments I'm going to add to that is I'm a believer in the don't raise unless you can absolutely multiply every dollar that comes in. But you also said if you're willing to sign up knowing the size of the market opportunity and that you can have a significant land grab in a short amount of time, I think people still need to consider whether or not they're ready to take the emotional and mental beating that it's going to take when you have the compression factor of success with somebody else's money and the accountability you have for a responsible use of those funds, and yet everything has to be done fast. And so that's another preparation I'd have our viewers and listeners consider. You've got to be ready for the onslaught of pressure. Ike, what do you think of that?
That and many other things, like what I see, the founders, they don't understand the like intricacies sometimes. When a VC comes, they haven't educated themselves. Like I've done this with myself as well. What I see the most cases is, oh, I want this valuation, and that's all I care about because I built this company so far and it should worth 5x, 10x, whatever my revenue. But there's many more variables in the equation that they don't consider. Like I'll give you, just yesterday I talked to somebody. He is Ike, I've been doing this for 4 years. They're over $10 million in revenue. I don't take any money to the to home, barely surviving. Like, physically, he's not doing well. And then these investors coming to him and say, "Look, your competitors got to $100 million, $200 million in 4 years. You're still struggling in the $10 million." He goes like, I asked them what the valuation, and they gave me 2x. of valuation. So I said that's the wrong question. Like ask them, when you guys put X amount of money, how fast can we go? When we exit, what is going to be my take? What's going to be your take? Just why don't you focus on those, like how you guys can work together to get some outcomes for both of you, rather than worry about right now my valuation is 2x. That's like one of the out of the million things. Valuation is just one item to talk about.
Yeah. Well, the other thing that you kind of hinted at there is, how often do venture funds also dictate how much a company should raise based on their fund size, right? Which is a personal pet peeve of mine, which is like, yeah, we have $100 or $500 million fund, therefore, we need to write a $25 million Series A check, and it's like, man, the company doesn't need $25 million at this stage, right? And if you give them $25 million, you're going to have to pay a much higher valuation in order to not suffer the same amount of dilution. And then they just have this huge like milestone that they have to hit that's incredibly hard to hit. And so you've increased the risk for everybody across the board. And and then you add in the fact that like when you have money, it's easier to be a little loose with the money, and not be as conservative and with it and as efficient as you probably need to be. And so I think it just sets up a lot of companies for frustration and failure too, where it's like, yeah, you focus so much on valuation and so much on like how much has been raised, and not enough on like what are the actual needs of the business to achieve like the next milestone, and so on and so forth. Because the other thing in venture is it's kind of a momentum game.
Yeah.
You want to raise the A and then the B and then the C and then the D. And like those are green flags when you do that. And even if, in my opinion, you have to sacrifice a little bit on valuation to do that, you'll end up in a better place, because I've seen so many deals, including deals I've done, where like they did an A and then an A2 and an A3 and an A4 because they didn't meet the milestone to hit a B. And the investors are frustrated because we're putting in more money and they're not hitting metrics, and they're frustrated because they're not, they just keep getting diluted and diluted. And so in my opinion, it's far better to be like very clear about, these are the outcomes we're shooting for. These are the milestones. Here's the capital we need to achieve it, and have reasonable valuations throughout.
Can I? Sorry, go ahead, Mike.
It's okay. Go ahead, Peter.
Hey, Peter, how do you balance how many of the portfolio families you beat over the head versus, okay, that's the way the dice rolls for these three companies. Those two are at least on par. That one's really crushing it. So as someone who manages all these hungry mouths who want more and more, ultimately money, how do you divide and manage the focus so that you are appropriately treating them at the level that they need? You're encouraging them, but at a certain point you got to move on. How does that decision come about, at least with your experience?
Yeah, I mean, it's a really hard conversation, right?
It is. Yeah.
And frankly, like I've honestly like gotten it wrong sometimes. In general, my philosophy is, and my experience has been, that your best performing companies don't really need or want your help, and they just kind of take off and do their thing. And sure, there are ways that you can be supportive and helpful, but if you really have true product market fit and a great team, like things just kind of pull you along. And then you've got like this middle group that's like still figuring it out. They're kind of in the wilderness, and some of those will figure it out and move into the first category, and some won't, and they'll move into the third category, which is companies that frankly, like it's just really never going to work out. And so I try and spend a lot of my time in that middle group where it's like, let's get you to a point where you're either moving up or you're moving out. And if you're in the group that's kind of moving out, then it's a lot of conversations around, hey, look, life is short. Just because this didn't work does not mean you are a failure. Let's find the next one, right? let's go after the next one and build that, instead of getting hung up and attached to a company that, you know, you spend decades at that never ends up going anywhere. You know, I think so a story on that, we very early on in my career, we backed this company. Actually, it was before my time that we invested. And then I came in and kind of took responsibility for that company. We were trying to help them. They had a CEO who is a phenomenal sales leader, just so good. And but for whatever reason, he was just like attached to this company and so afraid to leave and to shut it down and move on. And I look at it, and he's still running it. It's been 15 years since I first met him, still running it. Company still is doing maybe a couple million in revenue. I mean, it's basically flat from where it was, you know, barely breaking even. And I just look at that and I think, you know, what a waste. Like, he could have shut that down 14 years ago, started something new and put his incredible sales talent to like real work and gotten a ton more leverage on it. And I think like most VCs, we get this, right? It's in venture capital, you don't get penalized for your losses. You get penalized for the deals you missed out on, if that makes sense, because your downside is capped, but your upside is unlimited. And so, you know, from like a Vegas perspective, like you should be taking on lots of bets because you have unlimited upside and your downside is pretty much fixed. And so like when it really comes down to a given power law, like you're really rewarded for all the deals that you got into that ended up being successful, not the times that you lost. So what that means is that a VC, I know I'm going to have losses, and that's okay, right? Like I may pound the table and say, hey, we need to build something big, and like keep trying in the time and being, you know, encouraging and pushing a little bit there. But I also recognize like that's just part of the game. Talking out of the other side of my mouth, though, I'll give you another story and where I kind of got it wrong. I thought the company was in this third category of like, let's wind it down. And I took the founder to lunch and I was like, look, I don't want you to waste your life like this other guy has wasted his life. This clearly isn't working. You know, it's been a struggle to fundraise. You've had to pivot many times. It's not clear that this new pivot that you've got is going to work. You know, at what point do you just like hang it up and then start something new? And anyways, at the end of the lunch, he was like, you know, I really appreciate the perspective and everything, but I have a lot of confidence in this new pivot. And he ended up being right. And the pivot took off. We ended up exiting the business and generating a great return on the investment. And so, you know, these things are hard, I guess is the punchline. They're hard. And it's tough to say. But, you know, I think if you're struggling to fundraise, you're struggling to land customers, you've got limited number of months left, you know, I don't think there is any, you know, shame in hanging it up and starting something new and trying again, if that makes sense.
Yes, fantastic. And beautiful stories to illustrate that. And I guess grinning because of our experiences separately but throughout this life of starting businesses. One of the things I've learned over time is that the choice of the investor, not just the company name, the VC brand, is as critical as is getting the money at the right under the right terms, because the amount of care and feeding and love and transparency by my board member, by my investor, and the confidence I get from him, her, is crucial to winning in this ragged, high-intensity race. And as soon as I met you first time, 12 plus years ago, or more, I said, this is a good man. It is an important assessment of the person who's going to be part of the collective strategic team, not just the money. Ike, wouldn't you agree with that? What do you say?
100%. Yeah.
What's interesting about that is, so there's a fund called Correlation Ventures. They're very data driven. So you send them your materials, they put it into their algorithm. 2 weeks later, they give you a yes or no decision. But they have like one of the most robust data sets on performance of startups and VCs. And what they've shown is that it actually doesn't matter